Good afternoon and welcome everyone to the Trading Talk Uncensored live Q&A session. My name is Danny and I will give you the webinar today. So the agenda is to begin with the previous question that our team has prepared, which is this part, and then we'll skip to the dynamic questions, which are questions that you guys can ask along the webinar and see the answers on the screen. The third part is more informative, just to share with you some links here to save you the trouble to find it by yourselves on the website. Even though some of them are now accessible via the website itself and doesn't require you to even leave the website, as I'm going to show you later on this webinar. Lastly, as you can see, the slide in here is to help us emphasize analysis, just a little bit, nothing too crazy, using the examples here. But to be frank with you, I'd rather use live data on the chart. And it's important to know that any capital markets and trading information disclosed in this webinar is provided for informative purposes only and should not be constructed or applied as an investment advice, recommendation, or a suggestion. Furthermore, we understand that sometimes people want to watch the recording of the webinar, which is easily accessible via our YouTube channel. That means that you can go to YouTube, search for AvaTrade, and there you can find our channel, which is not only the recording of this webinar, but a lot of various content, such as analysis, risk money management, and all kind of other interesting things, which I highly recommend you guys explore. And like I said, we are going to begin with the previous questions, which are questions written here. And for that, we're going to get ourselves a nice notepad to jot down the notes, and we can first paste the question just like that, and then we can hover onto the platform. I'm going to say again that the platform that I'm going to use today is called the Web Trader. And to access the Web Trader, all you got to do really is just to logging into the website with your email and password. And the reason that I wrote also the AvaTrade's app is because I am using a desktop version. I'm using the version on the computer through my browser, but you can also access a similar interface using your phone. Again, just by logging into the app to the website, okay, with your email and password. Now, if you logging in the first time, the screen might not look like this. It might look like that. And how do you fix it? Just by clicking here on the two arrows, then you can expand the screen all the way up, and then you can prepare the way that you like. There are also a couple of things here that we're going to use to help us construct analysis that will stay on the chart, because whatever I'm going to do on the chart, even if I leave, even if I close this page, it's still going to stay, which makes things super comfortable, because I can just go back and do the analysis rather than to start from scratch again. All right, so the questions we've got today, the first one is, should scheduled withdrawals be included in a strategy? All right, I'll have to be honest that this is maybe the first time that this question appears in the webinar. All right. Okay, so first of all, what does that mean, scheduled withdrawals? Does that mean scheduled withdrawals? I mean, I can just go on my account to my personal area, click withdrawal, and make a withdrawal. What does that mean, scheduled withdrawals? Okay, so I assume that the question here is referring to designing withdrawals within the strategy. Now, there are two ways that I can have my, well, there are much more than two ways, but of course, the option A will be to compound, right? The second question is to withdraw profits. Now, of course, if I'm making profits, I want to withdraw my profits. But why would I want to schedule? All right, so let's suppose that I have $10,000 to begin with, and I'm able to sustain 10% per month, which accumulates roughly to 1,000 per month, which accumulates to roughly 12,000 a year, right? Which roughly, if I'll compound roughly the percentage with exponential growth, we're looking at roughly doubling my amount, a little bit more than that. Okay, this is without making a single withdrawal. That means that my balance eventually will be 22,000 plus. Again, we don't have the additional ingredient for the exponential growth, so we're measuring 10% in total from the initial amount, which brings us to that amount. Now this is without any withdrawals. That means that the following year I'll have 22,000 to work with. That's excellent. This way I don't enjoy any of the profits that I make. So of course I can make withdrawals here and there and to enjoy the profits that I make, but do I really need to schedule them? Well, if I'll schedule the withdrawal, let's suppose that I'm making 10% and I wish to withdraw 100 or 200 or 500 per month. What will happen is my balance will still grow if I'm able to sustain this 10%, but I will end up with a smaller amount. Not necessarily a bad thing, but as the question refers, as the answer that I'm going to give you, of course, it will be my personal opinion and nothing that you can establish as a rule or something like that. I'm just going to tell you that if you schedule your withdrawals and you're looking at trading like a second income, right, as an addition, I would rather design the amount and the times that I am planning to use the profits for. So if I don't have any specific target for my funds and I'm keeping in the account, okay, no problem. But what if I want to purchase something or I want to do something else with the funds? This way, if I'm having a strategy with a certain growth expected and a certain loss expected, I would design the withdrawal to leave me with enough margin to carry on with my strategy and not something too drastic that will devastate a strategy and will force me to reshape the strategy. Okay, if it makes sense. So this is what personally I would do. Of course, to compound or to withdraw profits, it's completely the choice of who's making the strategy, but that's the answer that I'm going to write down. Scheduling a withdrawal can be helpful as the withdrawal shouldn't affect my strategy drastically, which will allow me to enjoy the profits while keeping the strategy intact. Now, of course, this is, again, it's not a rule. I can decide that tomorrow I'm going to withdraw half of my capital, right? But this will significantly impact my strategy, which means that now I need to recalculate the exposure, recalculate the profits ratio, recalculate everything. So it's something to think about. It's option. I'm just opening you guys for another point of view, and you can of course use it as you like. Now the second question is, what is the benefit to working with a ratio bigger than 1:1? All right, let's first understand what is a ratio of 1:1. Okay, let's use something as an example. Doesn't really make too much of a difference. I think yesterday we looked at the indices. Maybe today we looked at one of the commodities and maybe energies. Maybe how is oil looking? Not bad at all. All right, second week's bullish in a gap. All righto, so for using oil as an example, first thing I'm going to do is lower the lot size to 0.01, and then I can quickly increase since we are with a buy and that seems bullish. We're going to go for a buy as well, and I can set the take profit just for the sake of the example to be $1 higher and the stop loss to be a dollar lower. We'll bound the entry to 16.5. This way we can flatten the take profit as well and flatten the stop loss as well. All right, so we're looking at 10 and 10. Maybe we'll push it up a little bit. Let's make it 100 instead. Okay, no problem. And we're looking at 1%. All right. All right. Maybe we'll push it a little higher as well, just like that. 250 barrels versus $1, giving us 250, and that is excellent. Now, let's jot that down. So we're looking at oil, entry 1695. This is a buy type. Take profit here will be, as we said, 70.5, and the stop loss will be 68.5. Now, this is $1 difference, as you guys can see, which leads us to, let's also jot down the lot size as well. 50 barrels. How is that, by the way, how is that 250 barrels with 0.25? I would expect 25, right? Well, the reason is because one lot has 1,000. Okay, as you can see, because one lot has 1,000 and we're using 25%, we're looking at 250 barrels. All right, which can leads us to 250 profit or 250 loss. Now, this is one position. Let's call it position A as an example. We're going to have a couple of positions to make this comparison. Okay, so we'll have A, B, and C. Let's maybe split the chart. This way we can work more efficient with multiple charts. Let's also add here silver or maybe gold. Gold just passed 30.50, isn't it? So might be interesting to see. We have here Dow Jones. Let's change it to, Corn is looking. Okay. And the last thing that we're going to use will be, let's go with NASDAQ. We saw that yesterday. NASDAQ is, yesterday it seems like it was slowly recovering. Today is bearish. As you guys can see, it's a bit difficult to see, but I guess it's not really important now because we're just trying to answer the question here. So we have a position with oil. Let's make another position, maybe with gold. So price now for gold is 30.50. Let's make it gold like this. This will be position B. Okay, still with a buy, no problem. Still 0.25 makes sense, 25. And let's maybe target $50 higher, assuming it will keep being bullish. So that makes it, entry will be a flat 30.50. Then take profit is 3.1. And then we've got stop loss at 3,000, which seems to make sense. And if we'll quickly do 25 ounces times 50 is, all right. Now let's validate quickly, clicking here on buy, setting lot size to 25. And the following thing is to set the entry as we said. Let's set the entry to a flat 30.50, take profit 3.1, stop loss 3,000. Excellent. That just makes sense, just like we wanted. All right. Third position with NASDAQ. NASDAQ seems fine. Let's look at 20,060. We'll do a similar exercise, this time increase with 100. So we have NASDAQ. All right, and let's make it 0.02. And then we can, let's look at the entry again. 60, okay. Let's make it 20,050. All right. and we will set the take profit for 21.50. Okay, and the stop loss to be let's make it this way. Okay. All right. And now, because we're looking at 1,000 higher and 1,000 lower, let me just show you quickly what I did here. So the price I'm looking to enter is 20,050 plus 1,000. That brings us to the 21,050, and 20,050 minus 1,000 brings us to, oh, sorry, it should have been like that. There we go. All right, and now because we're with 2 ounces, let me just show you that. I think it will be easier this way. Right, so buy and 0.02. Entry here, as we said, is slightly lower than the current, since we would like to optimize the entry a little bit. And then, all right, yeah, and yeah, all right. Just a second. Okay, so again, we'll do the calculation again. Oh, okay, I was right in the first time. There we go. All right. And now, all right, so we're looking at, maybe we'll reduce it to 0.01 just to make sense a bit more. Stays the same, perfect. So we're looking here at 1,000, right? So far we've got 250, 1,050, and 1,000. All right. And so far, all of our positions were designed with a ratio of 1:1. What does that mean, 1:1? We can make and lose potentially the same amount. We'll understand in a moment what will be the benefit using a different ratio. So for instance, I think this will be enough, right? How many positions we've analyzed? I think this will be enough. This will be quite enough. All right. So we've got 3 positions instead, and we'll make it ripple chart like this, and that is enough. All right. Now, because we're looking at a ratio of 1:1 in here, in case all of this position makes profits, what will happen is I make 250 plus 1,250 plus 1,000, which gets us to 2,500. Okay. Okay. Now, this will represent 25% out of my account. How can I know that? Because what I can do is I can go potential profit or loss divided by balance equals factor, and then factor times 100 equals percentage. Meaning if I'll divide 250 by, I'll divide 2,500 by 10,000 times 100, 25%. Excellent. The problem here now is that I'm looking at 25% both sides. Both sides. I think to make 25% in, let's suppose this positions will be hold for I don't know how long, maybe a couple of weeks, maybe even a month. I think 25% is not bad, but I think 25% to be exposed in terms of percentages that I could potentially lose might be a bit too high. So let's suppose that I want this 25% to be max of 5, right? Max of 5. How can I do that? Well, I can do one of couple of things. A, I can adjust the lot size to be smaller, but then it will impact my profits as well. What I can do the other way is I can get the stop loss closer on my positions. So I can take the same difference. In here we took 100, right? In here we took 50. Right? And in here we took $1. Potential average movement. This is the potential movement that I am expecting. Now, in all of those cases, what I can do is I can divide by 2, and then what will happen is I will slice the 25 to 12.5. Okay, another thing that I can do if I'm unhappy with the 12.5, let's suppose we want to take it to 5. Okay, so what I need to do is I need to take my reference divided by 5. Okay, so all of those differences, this will become 20 cents. This will become $25. Oh, sorry, this will be 10, and this will be 50. Something here doesn't make sense to me because now, oh sorry, that is 1,000. That is not 100. That is 1,000. There we go. All right. So now instead of looking at potentially losing 2,500, we're looking at losing 500. Now, what is this giving us? Okay, the benefit, so-called, using a different ratio. Well, of course, if we're using the previous ratio and all of the positions, God forbid, doesn't go well, we're going to simply wipe out 25% of our account. Okay, so in case 3 positions doesn't go well, this is how much we can potentially lose. It might not trigger any of the take profit and stop loss, right? But in a scenario that some of them make profits and some of them have losses, this one is a bit smaller, not a bit. This one is much smaller than those. But let's suppose that my NASDAQ position makes profit. And so let's just quickly adjust it. 250 becomes 50. That one we'll do with a calculator. And that is 200. All right. Now, the difference, 250, 250, yeah. The difference using a different ratio is that even if all these positions, I mean, even if 2 positions, the oil as an example, doesn't go well, okay, so we're losing 50. If this position doesn't go well, all right, so we're losing 250. This one, 200. It's enough for one of this position to make profits for me. And then if those hits the stop loss, I'm still going to make progress. That's the difference. And if I'm using a ratio of 1 to 1, will I keep making progress? Not necessarily, because my potential loss and profit is the same. So there is nothing here to compensate about the other. Okay, we've delayed about this question. I think enough. Do we have any questions about this question? How did you get to the percentage you wrote below? Well, Max, thank you for the question. The answer is that I simply compared it to my balance. This is the percentage. The percentage is compared to my balance. 2,500. Oh, sorry. This way, like that, it would make more sense. I think now it would make more sense. You see, 25% is 25% out of 10,000. 5% is 5% out of 10,000. Which means that like this, as I said, it's enough for me that I'll make profits in here or in here, and I can still make progress. All right, so the the answer to this question is designing the ratio to higher profits than loss sometimes can help compensate losing positions with winning positions. Why am I saying sometimes? Because it's very, very depending on the design of the strategy, the success of the strategy. Of course, we understand that all these positions are not guaranteed to hit either the take profit or the stop loss. Okay, so this is again not a formula. This is something you can use to maybe optimize the strategy, but as you know, nothing is guaranteed. All right, is there a significant difference between using a computer trading on a phone to a computer? Well, obviously the technical difference. Okay, we understand that using a computer with multiple screens and you know, the facility is more comfortable and bigger and so on, but the functionality doesn't really make too much difference, right? I mean, if I'm taking a position on the phone or on the computer, if it's the same position, it's the same position, right? But in terms of the facility and in terms of using the necessary tools to do analysis and all of that, maybe watching the market live data with multiple charts, I think the computer is more comfortable. It's more comfortable. Of course, that depends on the computer we're using, that depends on the phone we're using, but how can I say that? A standard device, standard smartphone versus standard computer, I think a computer would be a slightly more comfortable. Okay, that doesn't change the functionality. It doesn't change the functionality. I can still design the same strategy on the phone and on the computer. It doesn't make any difference. Maybe the indicators could look a bit small, but again, that depends on the device. I've already seen, you know, what's called this tablets. You know, those tablets. I've seen tablets the size of a computer. So you know, again, that depends on the device, but a native comparison between two default, not default, like I said, the standard devices, think the computer has a slightly, a little advantage. So I'm going to write here, rating on a computer might be slightly more comfortable to analyze live data, since again, as I've explained, multiple screens and a bigger sorry, and a bigger screen, and I guess you guys understand the logic here. Computer, okay, comfortable to analyze live data, since we can use multiple screens and yeah, you know, generally it's bigger. I mean, a computer, overall in general, on average, I think it's bigger than the phone. All right, so when should I close a losing position? Oh, just one more thing I wanted to mention regarding the this question here. When I'm sitting on the computer, sometimes I'm in a state of mind that I'm sitting down in my session to analyze and do things comfortably, knowing my, you know, the facility that I'm used to, and I can do it comfortably. Sometimes on the using the phone is a bit more maybe on the go. Okay, again, I might be wrong. Some people maybe sit home and using the phone, it's fine, but I'm saying overall, the reason that I might want to trade on my phone is because I'm doing something at the same time. So I'm doing it on the go. This is also something to consider. Just a second. Right, so The following question here is, when should I close a losing position? Okay, well, the obvious answer, okay, allegedly, we're going to speak about it and understand the logic behind it, obviously. It's not just going to end like that. But, I think I did something wrong. Let's see. No, we're still on. Okay, I thought that my screen froze for a moment, but it seems fine. All right, now let's select one of the, again, let's go for commodities, maybe agriculture, how is coffee looking like? Is it still, okay. Very, very interesting. We've got also some already pre-analysis here, not bad, not bad. All right, so the question here, let's paste it down, is when should I close? Now, let's suppose, again, my balance is 10,000. For the sake of the example, we're going to use the reference on this account. And with 10,000, we'll write here coffee, of course. And the current price, yes. Let's suppose that, let's go for a sell this time, and let's adjust lot size to 0.01. Again, we spoke about it with oil. How come 0.01 is giving us a 10? Because the lot size is 1,000. Yeah, that makes it, if we're using 1%, that makes it 10 and not 1. All right, now 330, now 3 is the current price. And if we would like to, let's suppose we would like to, let's get rid of everything we've got here. Let's, just a second. A quick check, guys, just a quick check. Just really quickly. All right, now what did I do just now? What did I do? I tested the levels of which I can assume that coffee will head down to. See, 372, maybe a little higher. Make it a flat 73. Yeah. See, just on the support line, right? Both cases. Let's put a rectangle here. Maybe an oval will be more point out, like that. Opening oval, like that. Again, opening oval, right. And of course, we have here the, okay. Now, so when should I close a losing position? First of all, the immediate answer I can think about is now, right? Let's suppose I'm losing. Well, I don't like to lose. I'm going to close it now. Okay, maybe. It seems like it's going down. Maybe we would like to ride that trend and go with the current price. Well, target is an example. Oh, just a second. We're simulating losing. Let's go with a buy. And let's assume that we bought it at 350. Okay, 350. This will be our entry. And God forbid, the take profit can be, let's assume, let's go a little higher than the support, right? Sorry, a little higher, we said. Now, let's suppose that this position rose to around the 400 area. It's maybe a little higher than that. Let's make it, yeah, that makes sense. Oh, sorry, we are with a buy, so vice versa. Of course, we can't do that because we're buying at 350, right? So since we're buying at 350, that doesn't make any sense. Let's go for 3. Just a second. 392.5. All right. Okay, we'll place it again. Don't worry, guys. Sometimes the lines jump to a different price, and that's completely fine. We can place it again, just like that. And we've got, let's paint the entry in white. Again, simulating a losing position. So this will be a buy. We bought it here. It went down to 380. Let's set the stop losses at 375. And to emphasize the loss, we can make it even lower down, maybe even lower than that. Okay, and maybe we'll increase this 0.02 to 0.5. No, we can't. We don't have enough margin for that. Maybe, no, this will be on the edge. That is enough. Now, when we're looking at 350 from an entry of 392, let's flatten that out. Okay, and that as well. So we're looking at 20% that we can potentially lose out of the, plan that out, then we can lose from the entry. Of course, this is not something that I would design in my strategy. Again, I'll show you the question to help you understand what we're doing here. When should I close a losing position? Okay, so we're just simulating here. We're simulating. None of the numbers that I'm showing you now is recommended to use. All right, so an entry would be 390. Take profit, as we said, we've targeted 405. It's painted in green. And God forbid, our loss ratio, let's get rid of the Fibonacci so we won't be confused by that. All right, so we've got 390 will be our profit ratio, profit area, and below we are going to have the red area, which helps us understand what happens if it goes lower down. So in this scenario, okay, the when I'm buying it at 390, okay, if it gets to 405, this is how much I can make, and this is potentially how much I can lose. Now, let's suppose we already opened this position. So we'll write down the numbers as if we have the position exists. So we've got entry. Okay, and I'll help you calculate what can be the result at the moment if it would go down against us. Take profit, we said 405. Okay. Lot size, as we said, is 0.05, which is 250, 50 units, right? Now, and the stop loss. So we're going to have stop loss and we have current loss. Okay. Let's maybe write it down. Okay, we'll keep it like this. Stop loss, as we said, is 350, which can lead to 2000. Okay. Okay. Now, if the current loss is coffee is at 382 and we have 50 units, so we've got 50 units times $10 away. Why $10 away? Because the entry is 390, right? So $10 away, so we're losing 500. Of course, if it will proceed going down, then we can potentially lose 2000. Again, I AvaTrade and I've placed it here. But let's suppose that we're, at the moment, this is the situation that we're having. Current loss is this. Now, what should we do? All right, so the obvious answer would be to close the position right away, right? Because we don't want to keep losing and so on. We see the stop loss here, potentially 20%, and that's a lot. Well, I wouldn't say it's a lot, but it depends on the percentage you're aiming for. At the moment, we're losing 5%, and we need to think what to do. All right, so the first thing that I'm gonna do is I'm gonna compare the stop loss that I've designed, and I will check the statistics of when I assume that it can go back to that price. Okay, if I have targeted, this is very, very far away, but again, we're gonna keep using that to demonstrate what to do. Now, I can see the 405 that I've targeted as profit. Last time that it's been there was yesterday, right? It was there yesterday. So I have a reason to believe that it might go there maybe in a matter of a day, right? Might be wrong, but statistically, that's what I can think about. All right, so in this case, I'm comparing the level that is, let's see, 350. Last time that it was there was on January. That was a good few months ago, right? So we've got few months ago versus yesterday. Okay, so what I can do here, instead of closing the position, I can first move my stop loss higher to a place that I feel more secure. Don't forget that I'm losing 500 since we've simulated opening the position at 390. So at the moment we're almost $10 down. Okay, now I can set the stop loss to be around the support as an example, 370. And if it goes another $10 down, we're going to potentially lose 1,000 and not 2,000. Okay, that's the first thing. The second thing that I can do is I can set myself on my calendar to analyze this position tomorrow again, and then I can see where the position is at. If I see that the position is turned around, as an example to the entry, let's suppose, okay, back to 390 like this, then I can choose if I want to close it and break even, or I would like to let it run, okay, and hopefully I can get to profits. If it doesn't go well, if it goes even further down and trigger the stop loss, well, it closed by itself. I didn't need to close it. The third option is that it will consolidate. And as you can see here, coffee hasn't passed those levels since, just a second, we'll move the timeline like this. We see that since the 3rd of March, 3 weeks, that coffee hasn't reached those levels. It hasn't reached those levels. Again, it can happen tomorrow because we can see that it's been bearish and those are big candles compared to the previous. But if it doesn't and tomorrow I'll analyze the position, I might change my mind, okay, depending on how good the position will go. So to answer the question here, when should I close a losing position? Well, the answer for me would be to when should I close? If I feel that the position exceeds the exposure that I have set, or the time that I was planning to hold a position, because I'm not going to hold a position forever, as in what I designed initially. That depends on the trading style. Sometimes if I swing, I can hold it for months. But if I'm not trading swing, maybe I'm intraday or weekly or something like that. So I like to have a certain time frame that I'm planning to hold this position, so I won't get stuck with it. Okay, and then I'm paying swap, which is overnight fee. All right, or the time scheduled to hold the position. Okay, those are the this is what I would do in my own tradings. Okay, we'll make it smaller. Of course, the first option is also viable. Just for you guys to know, I didn't mention it because it seems natural, self-explanatory. But of course, if I'm losing 500 and I'm not happy with it, I can just close the position. Go here to positions. The positions will be displayed in here. In here, we have X at the top right. Click on the X, close the position. Right? This is an option. But I was hoping to open your mind, guys, to other options that you can use. All right, so this is enough what we went through. I think we've covered all the necessary questions we've got from our team, and we can carry on with ease to this slide with the information, which I can share with you the links. And as I said, and as I promised in the beginning, I'm also going to show you a way how to access those things from the website. All right, so I'm going to share it via the chat. Just like this, you've got the link for the AvaTrade's education section, and you can find a lot of useful content there, such as analysis and risk money management and basic explanations about all kind of things and Forex. Very, very interesting. I highly recommend you guys to check that out. The second thing is just to log in and make a deposit to help you do that. The third is the FAQ in the Help Center for more official kind of maybe questions you may have. And the real account is, well, it's a real account. If you're still on the demo and you want to get down to business and practice for real, so this is a very nice way to do that. And lastly, the Academy, which again, I'm going to show you from the website. But before I do that, I would like to give you guys, because you participated today in the webinar, I would like to give you today the Q&A benefit to give to your senior account manager. And what this will give you is one-on-one premium market review with your senior account manager. You'll be able to enjoy speaking with your account manager, looking at the market, ask any questions you may have, which to my opinion is the most practical thing that you can receive. All right, so enjoy, take the Q&A benefit, just give it to your senior account manager and enjoy that. All right, and as I've explained, I'm going to show you now how to access the Academy from the website itself. So very easily, when I'm logged in, I see this blue interface in here. What I can do at the left area here at the bottom, we have the button here for tutorials and Academy. I can just click on Academy and it will take me to the Academy. And above that, we have tutorials. And with tutorials, we get tutorials. And here to the right, we have all kind of things. Look what a nice wide selection of things. All kind of topics and entry orders and stock market fundamentals, all kind of things, Forex. Really, this is all this content you guys can enjoy just from inside the website. You don't even have to leave the website. You can just click here on play and it's running with sound and everything. All right, so guys, unfortunately, we ran out of time for today. I hope you enjoyed today and you learned one thing out of this webinar. So you're all welcome to join us next week. Until then, I wish you all best of luck with trading. Have a fruitful week and have a good day.